You must have watched the advertisements on TV showing people fulfilling their parents' lifelong dreams, solving their financial problems, or buying high end cars from their share market returns. Those are nothing more than the marketing gimmicks. They only show one side of the coin. If you are not careful in share market, you could in fact lose all of your investment. Have you ever thought of what you should be aware of? People enter into the share market without knowing the risks associated with it and the ways to manage them. In this video, I will discuss all the major risks in the share market, and at the end, I'll share 7 ways to manage those risks. So, the risks in the share market can be broadly categorized in 3 types. First is the systematic risk, or also called as the market risk. This refers to the risk of losses due to factors that affect the overall performance of the financial markets and general economy. Second, unsystematic risk, also called as specific risk or diversifiable risk. This type of risk is specific to a particular company, sector, or industry. And third is the other risks. All other risks come under this category. Let's understand each of these risks starting with the systematic risks. So the systematic risk can further be subdivided into 6 risks. Let us go through them one by one. So the number one is economic downturn. A slowdown or recession in the Indian economy can lead to lower corporate earnings and a decline in stock prices across the board. Number two is the interest rate risk. Changes in interest rates by RBI can impact borrowing cost for companies and the valuation of assets, particularly interest sensitive sectors like banking and real estate. Rising interest rates can make bonds more attractive than stocks, leading to a fall in stock prices. Number three is the inflation risk, also known as the purchasing power risk. Rising inflation can erode the real value of investment returns. If the returns from your investment are lower than the inflation rate, your purchasing power decreases over time. Number four is the geopolitical risk. Events like wars, political instability, both domestic and international, and changes in government policies can significantly impact market sentiment and investment flows. The recent Pahalgam terrorist attack, Israel Hamas Palestine war, and Russia Ukraine war are few examples. Number five is the liquidity risk or the market liquidity. This risk arises when it's difficult to buy or sell an investment promptly at a fair price. In a market downturn, some stocks might become illiquid, meaning you might not be able to sell them easily. And at number six is the currency risk, also known as the exchange rate risk. If you invest in foreign stocks or if Indian companies you have invested in have significant foreign currency exposure, fluctuations in the value of the Indian rupee against other currencies can impact your returns. Let's now move on to the next category, which is the unsystematic risks. So, the unsystematic risks, also called as the specific risk or diversifiable risk, can be subdivided into 5 risks. Number one is the business risk, the risk that a company's operation might be negatively affected by factors like poor management, changes in consumer demand, increased competition, or technological disruptions. Kingfisher Airlines, led by Vijay Mallya, is an example which caused significant losses for its shareholders. Number two is the financial risk. This relates to how a company finances its operations, including the level of debt it carries. High debt levels can increase the risk of bankruptcy, especially during economic downturns. Number three is the credit risk, also known as the default risk. The risk that a company or borrower will fail to repay its debt obligations, principal and or interest. This is more relevant for investment in bonds and debt instruments. The infrastructure leasing and financial services (IL&FS) crisis in 2018 triggered significant credit risk concerns in the market, impacting the stock prices of companies that had lent to or invested in IL&FS and its subsidiaries. Number four is the industry specific risk. Certain industries may face unique challenges due to regulatory changes, technological advancements, or shifts in consumer preferences. For example, the telecom sector in India has faced regulatory and competitive pressure. The ban on certain diesel vehicles in Delhi and other cities to combat pollution negatively impact the sales and stock prices of automobile manufacturers. that had a significant portfolio of diesel powered vehicles. And at number 5 is the volatility risk. This refers to the fluctuations in the price of a stock or other assets over time. High volatility can lead to significant short term losses. Adani Group stocks experienced extreme volatility in early 2023 following the release of a report by a short seller alleging financial irregularities. Some stocks saw massive declines and subsequent recoveries. Let us now check the third and final category of risks called the other risks. The other risk category comprises of six risks. At number one is the regulatory risk. Changes in government regulations and policies can negatively impact specific sectors or the overall market. For example, new environmental regulations could affect manufacturing companies. The Supreme Court's ban on iron ore mining in certain regions, for example, in Goa on multiple occasions, significantly impacted the production and profitability of iron ore companies and related steel companies in those regions. Number two is the political risk. This is the risk that political instability or changes in government policy within India could negatively affect investment. This can include changes in tax laws, trade policies, or foreign investment rules. Unexpected election results or significant policy changes by the Indian government, such as major retrospective tax laws in the past, have occasionally led to a negative impact on foreign investment and market sentiment. Number three is the concentration risk. Investing a significant portion of your portfolio in a single asset, sector, or a small number of assets increases your exposure to the risk associated with those specific investments. Investors heavily is concentrated in specific sectors like IT in the late 1990s, early 2000s faced significant losses when the dot-com bubble burst. At number 4 is the event risk. Unexpected events such as natural disaster, terrorist attack, or corporate scandals can have a sudden and significant negative impact on specific companies or the entire market. The COVID 19 pandemic in March 2020 was a major event risk that triggered a sharp and sudden downturn across the entire Indian stock market. At number 5 is the liquidity risk. Even within the overall market liquidity, individual stocks or bonds can have varying degree of liquidity. Some smaller or less traded securities might be difficult to buy or sell in large quantities without significantly affecting the price. And finally, at number 6 is the operational risk. Risk arising from a company's internal operations such as system failure, human error, or fraud. Recent volatility in banks shares or Gensol is an example of this type of risks. Now, while some of the risks like market risk cannot be entirely eliminated, investors can employ various strategies to manage and mitigate risks. There are seven ways the risks can be managed. Number one is diversification. Diversification means spreading investments across different companies in different sectors like finance, IT, FMCG, etc. Pooled investments like mutual funds, ETFs, etc. Different asset classes like corporates, bond, gold ETFs, REITs, etc. And different geographies like share markets of other countries like US, UK, China, Germany, etc. This is the single most critical way to manage the risk in the entire share market. Number two is the asset allocation. Asset allocation is about deciding what proportion of your total investment portfolio should go into each asset class, like stocks, bonds, etc. This decision is based on several factors unique to you, like risk tolerance, time horizon, financial goals, etc. Third way is the long term investing. Long term investing involves buying and holding investments for an extended period, typically several years. This strategy aims to benefit from power of compounding and the overall growth of the economy and business over time. The stock market can be volatile in the short term with prices fluctuation due to various factors. Long-term investors are less concerned with these short-term swings and focus on the long-term upward trend historically observed in the market. Fourth way is the fundamental and technical analysis. Fundamental analysis is like understanding the health and potential of a business before buying it. Technical analysis is like studying the stock price history to predict where it might go next. Investors should use a combination of both approaches. Number fifth is the stop loss orders. Now, a stop loss order is an instruction you give to your broker to automatically sell a stock if it reaches a certain price. This is a crucial risk management tool to limit potential losses. Just for an example, if you buy a stock at say rupees 100 and you might set a stop loss order at rupees 90, if the stock price drops at to 90, your broker will automatically sell your shares, limiting your potential loss to 10 rupees per share. The sixth way is hedging. Hedging involves taking strategies to offset potential losses in your existing investments. It's like buying insurance for your portfolio. Common hedging techniques include futures and options. Keep in mind that hedging strategies can be complex and often involve additional costs. They are generally used by more sophisticated investors. And last, at number seven, is regular review and rebalancing. The market is dynamic, and your investment portfolio can drift away from your initial asset allocation over time due to different performances of various asset classes. Regular review and rebalancing are essential to maintain your desired risk level and stay aligned with your financial goals. So now you know all the major risks in Indian share market along with ways to manage those. Understanding these different types of risks is crucial for investors to make informed decisions and manage their portfolios effectively. I sincerely hope that you have learned something new in this video. That is all from my side. Thanks for watching it. Please like this video and subscribe to the channel, and I'll be back soon with another video. Goodbye for now.